Hey everyone, Graham Stephan here. Today, we're diving deep into the recent earnings reports from two fintech giants, SoFi and PayPal. Both companies absolutely crushed it, exceeding expectations and showcasing their strength in a volatile market. But before we get started, hit that subscribe button and leave a comment below with your thoughts on these companies. Let's start with the numbers. SoFi blew past analysts' predictions, reporting a significant earnings per share beat and exceeding revenue forecasts. This impressive performance was fueled by a surge in new members, demonstrating the appeal of SoFi's expanding suite of financial products. On top of that, SoFi raised its guidance for 2025, signaling strong confidence in its future prospects. PayPal also delivered a stellar earnings report, boasting a robust income statement, lower transaction expenses, and soaring net income. Their balance sheet remains rock solid, and they're returning value to shareholders through a substantial share buyback program. Both companies are firing on all cylinders, but the market hasn't fully recognized their achievements yet. More on that later. But before we jump into the market reaction, let's take a closer look at what's driving the success of SoFi and PayPal. We'll break down their business models, analyze their key growth drivers, and explore the potential challenges they face. Get ready for an insightful deep dive into the world of fintech. SoFi's strategy is simple but powerful. Attract new members with a compelling value proposition, then expand their financial relationship by offering a comprehensive suite of products and services. This strategy is clearly paying off, as evidenced by their impressive member growth. SoFi added a record number of new members this quarter, demonstrating the strong demand for their innovative financial solutions. SoFi's success can be attributed to several factors. First, they offer a wide range of products including student loan refinancing, personal loans, mortgages, and investment accounts. This one-stop-shop approach simplifies financial management for their members and encourages them to deepen their relationship with SoFi. Second, SoFi leverages technology to deliver a seamless and user-friendly experience. Their mobile app is highly rated, and their online platform is intuitive and easy to navigate. This focus on technology allows SoFi to operate efficiently and pass on savings to their members in the form of competitive rates and fees. However, it's not all sunshine and rainbows for SoFi. Their Galileo platform, which provides technology infrastructure for other fintech companies, experienced slower than expected growth this quarter. While this stagnation is a cause for some concern, it's important to remember that SoFi's core business remains strong and is more than capable of driving continued growth. Now, let's shift gears and examine PayPal's impressive earnings report. PayPal's income statement is a thing of beauty, with revenue soaring, transaction expenses declining, and net income reaching new heights. This stellar performance is a testament to PayPal's dominant position in the digital payments market and their ability to consistently generate strong profits. One of the key drivers of PayPal's success is their massive scale. With hundreds of millions of active users worldwide, PayPal processes a staggering volume of transactions every day. This enormous scale gives them significant bargaining power with merchants, allowing them to negotiate favorable fees and keep their transaction expenses low. Moreover, PayPal's balance sheet is a fortress, boasting ample cash reserves and manageable debt levels. This financial strength provides them with the flexibility to invest in growth initiatives, pursue acquisitions, and weather any economic storms that may lie ahead. And let's not forget about their generous share buyback program, which returns billions of dollars to shareholders and boosts earnings per share. However, PayPal does face some challenges. The company acknowledged concerns about potential risks associated with Chinese merchants on their platform. To address these concerns, PayPal's CFO provided improved guidance, assuring investors that they are actively monitoring the situation and taking steps to mitigate any potential negative impact. So, both SoFi and PayPal delivered knockout earnings reports, exceeding expectations and really demonstrating their strength in a competitive market. So why haven't their stock prices skyrocketed? The answer, in short, is market uncertainty. We're currently in a period of heightened market volatility, with investors grappling with inflation, rising interest rates, and, geopolitical tensions. This uncertainty has made investors skittish, and they're honestly hesitant to jump into any stock no matter how good the earnings report might be. Think of it like this. Imagine you're at an amusement park and you see a roller coaster with a line of people eagerly waiting to ride. You ask someone who just got off the ride how it was, and they say it was the most thrilling, exhilarating roller coaster ride of their life. But then, you look up and see storm clouds gathering overhead. Would you immediately jump in line, or would you hesitate, wondering if the ride might be shut down due to the approaching storm? That's the situation we're in right now. SoFi and PayPal are the thrilling roller coasters. Their earnings reports are the glowing reviews, and the market uncertainty is the approaching storm. Investors are hesitant to jump in, even though the fundamentals are strong, because they're worried about what might happen in the broader market. Despite market uncertainty, I remain bullish on SoFi and PayPal's long-term prospects. Their strong fundamentals and growth make them compelling for patient investors. Let's talk price targets. I see SoFi reaching $25, $50 per share in 3 years. For PayPal, my target is $120, $200 per share. Remember, these are targets, not guarantees. The market is unpredictable. One key factor is the hype cycle. Periods of excitement, followed by corrections. So, should you buy, sell, or hold SoFi and PayPal? As always, the answer depends on your individual circumstances, risk tolerance, and investment goals. However, I believe that both companies are well positioned for continued success, and their recent earnings reports only reinforce this belief. If you're a long-term investor who's comfortable with some volatility, then buying SoFi and PayPal at their current prices could be a smart move. However, it's important to remember that all investments come with risk, and there's no guarantee that SoFi and PayPal's stock prices will go up. It's crucial to do your own research, understand the risks involved, and make sure that any investment you make aligns with your overall investment strategy. Don't forget about portfolio management. Diversification is key to mitigating risk and achieving your long-term investment goals. Don't put all your eggs in one basket, even if that basket is filled with promising fintech companies like SoFi and PayPal. Spread your investments across different asset classes, industries, and geographies to create a well-rounded portfolio that can weather market storms. That's it for my analysis of SoFi and PayPal's recent earnings reports. I believe both companies are well-positioned for continued success, and their strong fundamentals make them compelling investments for long-term investors. However, it's important to remember that all investments come with risk, and it's crucial to do your own research before making any investment decisions. Now, I want to hear from you. What are your thoughts on SoFi and PayPal? Are you bullish or bearish on their long-term prospects? Let me know in the comments below. And don't forget to subscribe to my channel for more insights on finance, investing, and building wealth. Thanks for watching.